Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where, as always, we at least attempt to be the voice of reason in a world full of the pundits of pessimism and that scary wall of worry. As always, please make sure you read the disclosures that were attached to this video, or if you happen to be watching on social media, it's simple. You can just go to www.frossandfross.com and read any of the disclosures that you might find therein. So today we're diving into the latest developments from the Federal Reserve and what they ultimately could mean for the markets. So at the Fed's Jackson Hole meeting, Federal Reserve Chair Jerome Powell all but proclaimed victory in the fight against inflation and signaled that interest rate cuts are on the horizon. So just a little bit of background, following COVID, for a variety of reasons, we saw the inflation rate go to the highest level that we've seen in over 40 years. And as a result, the Fed raised its benchmark rate to the highest level that we've seen in 23 years, essentially raising rates to put their foot on the brakes of the economy to make sure that the economy doesn't get going so fast that, like a vehicle, it could drive off the road. So by raising rates, tapping on the brakes. And so what we've seen as a result is that inflation has began to come down steadily, and investors now expect that the Fed will begin to cut rates at its next meeting in September, an expectation that essentially got Powell's endorsement on Friday. So Fed saying inflation's coming down, maybe now's the time to start to take the foot off the brakes and allow the economy to start to do its own thing again. Powell cited the labor market in particular as cooling off, despite the fact that unemployment still remains at near historic lows and still is well within what the Federal Reserve determines as full employment. So the result of that is that it shifted the market's focus to the key question of when will rate cuts begin to happen and by how much. And as traders digest this news, many are betting on a 25 basis point or a 1/4 point reduction this month. This would mark the beginning of what many expect to be a prolonged period of rate cuts rather than rate hikes. But here's where it gets interesting. The likelihood of a more aggressive half-point cut are growing steadily. According to the 30-day Fed funds futures market, there's about a 1 in 3 chance of that happening. So getting a half-point cut rather than a 1/4 point cut. Now, what is the result of this? Well, if you're a saver and you're in fixed investments and you've enjoyed CD rates or money market rates being back up to at least acceptable levels, probably isn't good news for you. But if you're a borrower, let's say you're going to buy a new house or you're a large company that's borrowing money, well, this is great news, seeing interest rate cuts on the horizon. This larger cut could become even more probable if the August jobs report, which is due out this week, actually on September 6th, if that shows weaker than expected results, similar to what we saw last month, then the likelihood is that we get an even higher rate cut rather than that 1/4 point cut. Economist Paul McCulley shared his thoughts on CNBC Squawk on the Street, saying that he expects a 1/4 point cut over the next 8 meetings, which would total a 2% interest rate cut on the horizon. Once again, allowing the economy to be spurred on, taking the brakes off, which I think we would all like to see. So stay tuned as we get more information on what the Federal Reserve is going to do. And if you have questions about how this might impact your portfolio, feel free to reach out to us at the office, 352-205-7800.